All right, thank you. Good afternoon, everyone. I'm Amir Adnani. I'm the chairman of Uranium Royalty Corp. You heard me earlier discussing Uranium Energy Corp, where I'm the CEO of that company. Connection here is that Uranium Energy Corp is the largest shareholder of Uranium Royalty. We love the business model. I'll talk about it. And the CEO of Uranium Royalty, Scott Melby, is currently attending the inauguration of President Trump in DC, so he couldn't be here with us. So I'm going to give the presentation. And again, you can come to our booth 628 to learn more. We've only got about 10 minutes here. How many people, just by show of hand, are familiar with the royalty and streaming business model? All right, I love it. I love doing these talks in Vancouver because we're a resource town and everyone understands these things. It's actually amazing to think a lot of investors out there still are not as familiar as this room is with what this model means. Would you believe it that in the almost 70 years of uranium mining in the world, no company attempted to put together a pure play royalty company in the uranium sector? You think about Franco-Nevada, you think about Wheaton Precious, and all the commodities that we now have royalty businesses around. The uranium sector was missing this. And in 2019, as entrepreneurs, we decided to change that. And so Uranium Royalty is the first and only royalty company focused on the uranium sector in the world. What that really means is that over the years since this company was launched, now this is relatively still a young company, about 5 years old, we've got low-hanging fruit opportunities. We've got the first mover advantage. And that advantage means that over the years, as royalties were created by prospectors and were sitting out there in this existing marketplace, we've been able to go in and consolidate these royalties. Sometimes we've had to sign agreements with 75 individuals to get one royalty. Sometimes we have found these royalties owned by a church. Sometimes we've owned these royalties because a chemical company had it. There are all kinds of interesting, fascinating places where royalties on uranium projects are sitting. And we have that first mover advantage to go out there and consolidate these royalties. Of course, because the uranium price was below the marginal cost of production for almost 15 years, most royalties on uranium assets didn't pay anything. Because as you're all familiar, royalties pay if a mine is in operation. So now, as we're seeing this next wave of uranium mines come online, new mines get built. Why? Because of the supply-demand fundamentals of uranium, because of the deficit that we have in terms of uranium supply to meet existing demand. In the next 15 years, we've got close to 1 billion pounds of uranium supply deficit. This means that we're going to see higher uranium prices, and with that, we think the opportunity to generate cash flows from owning uranium royalties is very compelling. Of course, as you all know, the benefit and the beauty of the royalty business is you can have a very small team, very small operating costs. We don't invest in the mines, we don't invest in exploration. All of that happens by the owners, and we get to collect off the top line. Now, slight different business model here for us in that in the early innings of this uranium price cycle, we decided to also buy physical uranium. So what we're combining in these early innings is physical uranium ownership, along with a portfolio of 25 royalties that we've acquired, including royalties on Cigar Lake, McArthur River, the two largest conventional mines on the planet. Now, why are we buying physical uranium? Because we don't think at $75 a pound uranium price, the market is going to balance. There still is a deficit. How many of you guys invest in copper? Put your hand up if you're a copper investor. All right, so think about copper for a second. If the copper price had gone up 4x in 4 years, there'd be a whole new slew of supply online. The uranium price has done exactly that. It's gone up 4x in 4 years, and the supply is up by only 20%. Think about that. The commodity price is up 400%, the supply side is up only 20%. So what does that tell us? What that tells us is that the price must go higher because that is what's going to incentivize new supply. And so between now and then, we think one great way to create value for our shareholders is to actually own the physical, because the physical If it doubles from here, well, we've doubled our money. But we started the strategy when uranium was at $19 a pound. And today is a 75. So we almost have a 4X on our hands for our shareholders. So when you look at the balance sheet there, this company has $338 million of cash and liquid assets, being the physical uranium, okay? No debt. So what that means is that we've got a tremendous balance sheet where we can fund future royalty acquisitions from. And while we're waiting, we're collecting a much better premium, in my opinion, and upside in owning physical uranium than putting the cash in GICs. Does anyone know how much GICs are paying in Canadian dollars right now? Anyone know? About 3.3%. I think the upside to see it double is probably better just having the cash sit in cash, right? It's a very diversified portfolio. We're uranium people, and so the team that we've put together is really a group of individuals that have spent each multiple decades in the uranium business. Our team knows where the royalties are. They've built these uranium mines, they've operated them, and they understand where to find the value. The counterparties that Uranium Royalty has exposure to today are listed here. You can see from large companies to small companies, medium size. This is the name of the game if you're a royalty company, right? You build a diversified portfolio, many counterparties. You don't do any of the work yourself, but you create that basket approach to the exposure. We love North America. One of the reasons we love North America is if you look at the history of uranium mining in the last 30 years, 85% of production growth came from Kazakhstan and Namibia. There's been very little, next to no production growth in North America. And if I was betting, if I was looking at geopolitics, if I was looking at what's going on in the US and elsewhere, we think there's a really sound argument to be made that North American production is going to play a major role in supply side expansion in the next decade. So we've gone all in with exposure from Saskatchewan, northern Saskatchewan, Athabasca Basin, multiple projects from production to development, down to projects that we have exposure to in the US, conventional mining, in-situ recovery, all the above. And so again, it's while a global portfolio, because we also have a royalty exposure on Paladin's Langer Heinrich mine, it's very much North American focused as well. Again, you can't really argue with existing brownfield production. Projects like MacArthur, Cigar, and Langer Heinrich, these are, again, easy opportunities to be able to generate cash flow. These mines are up and running. And as we move forward here, these royalties, again, give us exposure to existing production, great exposure to development stage projects. We just picked up this royalty on Millennium. It's a 10% net profit interest, along with almost 2% interest on their Rough Rider project, which is owned actually by UEC. So when you look at the balance sheet and when you look at the shareholder base, this company is, again, very sound and very straightforward. Small team, number of shares outstanding, you can see 133 million shares. Majority of that is owned by institutional investors listed at the bottom left-hand side, along with UEC, Uranium Energy Corp, as 17% holder. No debt. And look at this right here. I mean, this is the key takeaway to look at and come back and visit us at the booth. Your market cap is $453 million, but just in cash and marketable securities and physical uranium, there's $338 million of value. So you're really, when you subtract the market cap, when you subtract the liquid assets from the market cap, it's actually a compelling argument for how much you're paying for 20 plus royalties on producing mines, development, and exploration. Companies trading at a discount to NAV right now, mainly because when you think about the royalty sector, size really matters. So if you're a multi-billion-dollar company like Franco-Nevada, you trade at a premium to NAV or net asset value. But if you're a smaller company and you're just coming up the curve, you might have a bigger discount, but with size and as cash flow projections increase, we think there could be an exciting re-rate on this company as well. As I mentioned, very strong uranium team, individuals who are at the booth that can answer your question. And really, in summary, in 15 seconds, first and only pure play uranium royalty company. If you're interested in the uranium sector, you got exposure to exploration, development companies, ETFs, this is definitely one different way, but a very proven model to get that commodity price exposure. Thank you very much. Hopefully we'll see you at the booth and at our 4 p.m. talk in the main stage on nuclear energy.